Hi, my name's Marlo Peterson. I've been practicing as a CPA in California for over 30 years. Many of you that watched my last video gave me some great feedback that the context was good, but that I needed to work on smiling a little more. Well, I need to remind you that not only am I a CPA, but I'm also a life insurance salesman, so I'm not really sure what you expected. In that video, we talked about how actual returns, especially after factoring in income taxes and advisor fees, were much less than average returns. If you didn't get a chance to watch that video, I hope you'll check it out at ontracktoretire.com. In that video, I mentioned that there were ways to have the safety of high-grade bonds, share in the higher potential growth of the stock market, and defer taxes until withdrawal or even withdrawal tax-free. Today, I would like to go over the basics of two options that have those three attributes: indexed annuities and indexed universal life insurance. You know, most of us know of Usain Bolt, the current world record holder in the 100-meter dash and considered by many to be the fastest man on earth. Do you know who Dennis Comito is? Well, Dennis ran 26.2 consecutive miles, averaging 4 minutes and 41 seconds per mile, and is the current marathon world record holder. Both athletes are the fastest on earth in their particular events. Most know of Usain Bolt, and although Dennis's accomplishment is just as impressive, far fewer know of him. Most of you are familiar with the traditional retirement savings vehicles such as 401ks. It would be my guess that just like most of you are not familiar with Dennis Comito, that most of you are not familiar with indexed annuities and indexed universal life insurance and the financial goals they can help you accomplish. Indexed annuities and indexed universal life insurance have several similarities. They are both acquired through life insurance companies. How safe are life insurance companies? Well, each state has its own insurance guarantee fund to protect policyholders in the event an insurance company is declared insolvent. Additionally, insurance companies are rated based on their financial strength by AM Best. In my opinion, only carriers with an A- rating or better should be considered, and an A or A+ rating is preferable. Although no industry is immune, insurance companies weathered the 2008 financial crisis better than banks and investment houses. They also work similarly in that when a deposit is made, the insurance company earmarks the majority of that deposit to purchase high-grade bonds. Let me illustrate. If we assume a $100,000 deposit and a 5% interest rate, the insurance company would purchase approximately $95,240 worth of bonds. The annual interest on $95,240 at 5% is $4,760. If we add the interest earned to the bond principal, we are back to the original investment at the end of the year. This allows the insurance company to guarantee accounts will never suffer a market loss. Both indexed annuities and indexed universal life insurance use a strategy called indexing. Indexing allows the owner to participate in the upside of an index, such as the S&P 500, without investing in the actual index. The way this works is that the insurance company offers several index choices, and once the policy owner has made their index choices, the insurance company will purchase call options based on those choices. At the end of the index period, which is typically 1 year, the beginning and ending index prices are compared. If the index selected went up, the account will be credited with all or a portion of the index increase. An index will either have a cap, a spread, or a participation rate that determines the portion of the index increase you receive. If an index is subject to a cap, you will receive 100% of the index increase up to that cap. If the index goes up 15% and your cap is 10%, you will only receive 10%. If an index has a spread, you do not receive the first portion of the increase up to the spread rate, but you do receive 100% of the increase above the spread rate. If the index goes up 15% and the spread is 4%, you will receive 11%. If an index has a participation rate, you will receive a percentage of the entire increase in the index. If the index goes up 15% and the participation rate is 60%, you will receive 9%. A cap, spread, or participation rate limit your gain potential. You may think that's not fair. If the index goes up 15%, you should get 15%. There is a trade-off. If the index goes down, you do not participate in the decrease. The worst you can do is 0. I know 0% does not sound great, but in 2000, 2001, 2002, and 2008, 0% would have been great. I would like to illustrate how index participation works by comparing it to the game of golf. Most golfers would love to be able to shoot par on every hole. Imagine if it was mandatory to take a mulligan on every poor shot you made. The trade-off is that you could never birdie, eagle, or make a hole-in-one. Not being able to birdie, eagle, or make a hole-in-one represent the index cap, spread, or participation rate, limiting the potential growth of the index choices you made. Mandatory mulligans equate to not participating when the index does poorly. We have seen how indexed annuities and indexed universal life insurance are similar in that they both provide the safety of high-grade bonds and are designed to share in the higher potential gains of the stock market. Indexed annuities and indexed universal life insurance have many similarities, but they also have some distinct differences. And it is the differences that determine which product is best for your particular situation. The tax on the income earned in an indexed annuity is deferred until funds are withdrawn. Tax deferral grows your nest egg quicker and leaves you with more after-tax money. Let me illustrate. If we assume a $100,000 investment, a constant tax rate of 33%, and an accumulation period of 20 years, with an earnings rate of 4%, the tax-deferred amount would grow to $219,112 in 20 years. If a lump sum distribution is taken at that time, the tax would be $39,307, leaving an after-tax amount of $179,805. The amount that would accumulate over 20 years if the tax was paid each year on the income earned is only $169,714. The benefit of tax deferral under a 4% earning scenario is $10,091. An investor who pays tax on their earnings each year would need to earn 4.4% annually to equal the results of the 4% tax-deferred accumulation. The benefit of tax deferral under a 6% earning scenario is $27,921. An investor who pays tax on their earnings each year would need to earn 6.93% annually to equal the results of a 6% tax-deferred amount. We can see by the 4% and 6% examples that the higher the rate of return, the exponentially higher the benefit of tax deferral. Indexed universal life insurance, on the other hand, is designed to be tax-free both during the accumulation phase and the distribution phase. Tax-free earnings help your retirement nest egg grow quicker, and tax-free distributions allow your retirement savings to go a lot farther. Let me illustrate. If we assume a $100,000 investment, a constant tax rate of 33%, and an accumulation period of 20 years, with an earnings rate of 4% per year, the tax-free amount would grow to $219,112 in 20 years. The amount that would accumulate over 20 years if tax was paid on the earnings each year is only $169,714. The benefit of tax-free under a 4% earning scenario is $49,398. An investor who pays tax on their earnings each year would need to earn 5.97% annually to equal the 4% tax-free accumulation amount. The benefit of tax-free under a 6% earning scenario is $100,757. An investor who pays tax on their earnings each year would need to earn 8.96% annually to equal the 6% tax-free accumulation amount. If you have the choice of tax deferral or tax-free with everything else being equal, the obvious choice is tax-free. But in life, all circumstances are not the same. So in some cases, an indexed annuity with its tax deferral is the best choice, and in other cases, indexed universal life insurance and its tax-free accumulation and tax-free distribution is the best choice. One thing is clear, however, tax deferral and tax-free are both powerful accumulation tools. Today we covered some basics of indexed annuities and indexed universal life insurance. In the next two videos, I will discuss indexed annuities and indexed universal life insurance in more detail so you will know how each might be used to accomplish your retirement and other financial goals. Most likely you know someone who has ran a marathon or attained a similar accomplishment. They sacrificed, were disciplined, and maybe wanted to quit somewhere along the way. Regardless of their time or place in the event, the accomplishment of finishing is the victory, and the reward is an increased level of confidence. My goal for each and every one of you is that when you cross the line into retirement, you will be confident knowing you will be able to maintain your lifestyle and not outlive what you have saved for retirement. Thank you for watching.